Good evening, everybody. It is Tuesday night, September 14th, 2021, and this is the last Tuesday webinar that we'll be doing. I am going to be going back to Monday nights where I do several small webinars and then package them up for easy, quick consumption. Tonight, we are going to talk about the way the indexes are moving versus what we can do with picking out stocks. And I think it's important for people to understand that the stock market's averages are driven by the biggest constituents in a particular index, whether that's the S&P 500 or QQQ or IWM. And that is because these are all cap-weighted indexes. So when Microsoft and Google and Apple and Amazon and Tesla all move up, S&P 500 and QQQ go up. When those all go down, S&P 500 and QQQ go down. Now, there are 95 other stocks on QQQ, and there are 495 other stocks on the S&P 500. So in many cases, the smaller cap stocks have already had a period of consolidation or correction since about February in many cases. So when we think about the market, you're really thinking about the biggest stocks. When you think about picking stocks, that's everything else. You really don't want to think that, oh, I have to wait forever to buy anything because the stock market probably is going to correct. Well, all you're really saying when you say that is your larger cap stocks are going to correct and the good ones will rebound and the bad ones probably will rebound slower. In many cases, the zombies that are kind of in the middle, and in particular near the bottom of those indexes, those are the ones you really have to avoid. And that's where I pick on really a lot of other, I'll call them fake analysts. I mean, if I wouldn't subscribe to them, I don't know why anybody would. When I'm looking for investment opportunities, I'm looking for asymmetric opportunities. I'm looking for roughly the market risk with a lot more upside, or if I'm managing money for retired folks, I'm looking for roughly market returns with a lot less downside. Where I'm really willing to take market risk is in some of these small cap stocks that I've been buying, where I can buy them basically for book value. And honestly, we have companies, because they were SPACs, we have companies out there that their cash holdings are essentially similar to their market cap. What does that mean? If you can get a stock in a company where they have $300 million in cash and the market cap is $400 million, you're basically buying this company for $100 million. In a lot of cases, especially the SPACs, the cash and the market cap are incredibly similar right now, right? So as their stock price hovers around 10 and they're not burning a lot of cash in most of the cases that we're in, you take a look and you go, huh, that's a pretty good deal. I basically get a pile of cash. Business is valued at almost nothing. All they have to really do is stay in business and you're going to do pretty well. When you take a look at crashes over time and you say, okay, when Freeport-McMoRan has been down in single digits, when Apple has dropped 30 to 50%, which has happened a few times, when Microsoft has dropped off a cliff, which only has happened a couple times, when littler companies, really companies of any size at all, when they trade so far down on pessimism and because momentum just keeps dragging them down, because people keep chasing, whether it's up or down, you get some pretty interesting opportunities. And one of the things that I learned was when a company is priced for oblivion, when it's priced for the likelihood of going bankrupt or never ever making any money at all, and you can get it for basically book value or sometimes below book value, there's only one question to ask. In 5 years, will this company still be in business? Because if the answer is yes, eventually the stock market will change its mind. It'll be consolidation. The bears will fade away because they made their money. New buyers will come in. Analysts like me and bigger and bigger and bigger investors will start to buy up shares. And so when you think about the market, I want you to realize that as we go through what could be a period of consolidation here over the next several months or even a couple of years, or if we go through an outright correction, you have to look at the stocks separate from the market. And if you're going to buy stocks, your only job as an investor is to get good risk-adjusted returns. Meaning, you have to decide, do I want roughly market level risk, or do I want lower than market level risk? And if you decide that you want below market level risk, then if you can grind out 10, 11, 12, 13, 14, 15% a year, you're spectacular, right? Because that's more than the stock market will generally average over a long period of time. Even though for some reason, the apes and the retards, and I say retards because that's their word, think that this is normal. This isn't even normal. This especially isn't normal. So historically, the stock market has averaged 10 to 12% per year. We should expect that that's about what it'll do in the future, long term. And when we have long periods of overperformance, that's generally followed by either a period of underperformance or a long consolidation period like we saw in 2015 and 16, which is a time period that I've talked about over and over and over again. So when it's time to buy your stocks, you look and you say, okay, has there already been a period of consolidation or correction somewhere in the market? And if the answer is yes, you can probably find some bargains. You can find companies that are priced as if they won't exist in 5 years, as if they're going to oblivion. Now, in general, I'm willing to take stock market risk. Why? Because I think that I can double or triple the market return with similar risk to the S&P 500 because I don't have a lot of respect for the S&P 500. I think that the S&P 500 is a shit index with 1 to 200 zombies, companies that I fully expect won't exist in 10 years or will be much, much smaller and on a different, smaller index. Then a lot of the small companies, a lot of the $500 million, billion, $2 billion, $5 billion companies in 4, 5, 6, 7, 10 years, they will be on the S&P 500. So stocks that you buy today with $1 billion or $2 billion market cap, they'll be worth 10 billion or more sometime this decade. And everybody's going to be talking about them when that happens. You'll be able to say, yeah, I bought it when it was $1 billion. I bought it when it was $2 billion. I recently had an investor say to me, I just don't have the patience you have. Here's a retired dude with a few $100,000 who doesn't want to change what he's doing. Telling a 51-year-old with Steve Austin money, I just don't want to do it that way. You know, I can only say so many times what I'm trying to say. And that is, stop investing like all the idiots that are out there. The boomers have been very bad investors over time. They've been emotional, and they have fallen for the same hook and line and sinker multiple times. There was an episode of Lassie that I watched as a kid, and the little boy made some sort of mistake, and he ran into the same, and he got in trouble. He ran into the same situation a little bit later, and he fixed it. He did it the right way. Went to Pa, and Pa says, yeah, I saw what was going on, and the kid says, yeah, I'm really sorry about the first time. And he goes, you know what, though? You learned. And smart people learn from their mistakes. And I'm not trying to be super harsh here, but I think that it's time for people who have failed to make big returns in the stock market make a decision. And that decision is, I'm either going to become an indexer and live with whatever the market does, or I'm going to throw out 80+% of the stuff that I hear and see and think might be right. And I'm going to stop saying, well, I think this one might be okay, or I heard what they said about this. And you're going to start thinking about companies like you're the CEO or the CFO. And when you do that, when you think about a company like an executive who's looking for a stock bonus, you think about it a lot different. You start to go, okay, I don't need to perform this year and next year. What I need is put myself into a position where I can hit the hockey stick and have a straight up ride and make 100 or 200 or 300% in a quick period of time. Now, I know the day traders, I know the shooter, I know that a lot of people try to catch a couple pips here, a couple bips there, whatever they call those things. Pips and bips, right? Is that what it is, shooter? Pips and pips? I'm a little fired up because I just keep hearing people talk about the little trades. Look, I get it. If you're a really good trader, you're going to do really well, but you're probably only trading 5 or 10% of your portfolio. I don't know a single trader out there who's trading more than half of his portfolio. Most are well under 20%. 5 to 10% is pretty common. I'm around 10%. 90-ish% of your money, give or take, should be these longer term position trades. Position trades you measure in quarters and years. Swing trades you measure in months and weeks. And then day trades you measure in days and hours. Pretty simple. So you need to understand your time frame. You need to understand what you're trying to accomplish. You need to understand the companies. You need to stop thinking about, oh, this one's okay. This one looks kind of good. You need to break it down to what am I risking? And the answer is always at least half of your money. What is my upside? So if you're always risking half of your money in any investment, and if you're in stocks and don't believe that, you shouldn't be in stocks because there's not a single stock in the world that can't drop 50% quickly. Nobody thought GE was going to drop from 35 to 5. It did. Go through the list of companies that dropped 50, 60, 70, 80, 90% or 100% in your lifetime. You say, wow, nobody saw that coming. Baloney. There's always somebody that sees it coming. You know why? Because there's people out there that short. All those oil companies that went bankrupt 6 years ago and then again 2 years ago. There's another wave of oil stock bankruptcies coming. Norway is about to make a decision on how many oil stocks to cut. OPEC wants to make money before the end of the oil age. There's another wave of oil stock bankruptcies coming. I'm not exactly sure how it'll manifest. That's where the traders come in really handy. We say, hey, I got this thesis. Tell me how close it is to happening. That's where technical traders are spectacular because they can tell you usually within 1 to 3 days for the superstars where the inflection points are. I usually get it to within a month or two. Shooter here, this is his chart that you're looking at. He works too much as far as I'm concerned. But we've been tracking the S&P 500 chart with him, and it looks like the S&P 500 can keep grinding up. And this is about a week old. You take a look at my version. I'm going to go to the daily chart. You see, that doesn't look too ominous just there, does it? Came down 2%, 3% now. So it's had a 3% decline since whatever it was, last Monday or Tuesday, whatever day that is, September 2nd. Been about 10 trading days, 9 trading days. Stock market's down 3%. People are getting all weirded out. But it happens. Look at all the times it happened. And then it just went right back up. So if you're trading the S&P 500, one, it's almost always going to go up, right? 80% of the time it goes up. And you almost always want to buy the dip. The only times you don't want to buy the dip are when it's overbought, and especially when it's overbought and overvalued at the same time on a longer term chart. Take a look at RSI. These are the times where you wanted to sell when you're up here. And just last week or 2 weeks ago, I told you when it hit here, it's probably going to get a small correction. The question is, does it get a little rebound and then keep on going down? Do we get a classic 3 or 5 wave correction? I'm not sure yet. And this is where I come to Shooter and say, okay, is this manifesting into 3-wave or 5-way down correction? We don't know just yet. When you take a look at QQQ, again, comes up, comes down, but it stays on that trend line. Got that right here. Right? Doesn't look too scary, but this right here, this actual pattern right here, it's either going to really rally hard for some reason, or it's getting ready to take a breather for some reason. And we've looked at valuations, so we know that everything is overvalued at the top, which makes the whole index overvalued, but it doesn't make everything in the index overvalued. And last week, we talked about how indexers were making the extremes more extreme. So if the stock market sells off, and if the indexers panic sell because the stock market drops more than whatever their pain threshold is, then it'll drop more. Talking to my nephew, who's in the Air Force, his friends all trade stonks, and they're all telling me about AMC and GameStop. AMC in particular, they like. And I told them, I said, look, AMC is essentially a bankrupt company that for whatever reason your generation decided to bail out. And now it trades at, 10, 20 times more than it should. Not 10 or 20% more, 10 or 20 times more. Should be a $5 stock at best. GameStop, I wrote a theory 3 years ago saying, hey, if they can convert their business to make it more digital and experiential, the articles were on Seeking Alpha, that they had a shot. Never thought it would go to 350 or 450 or whatever it went to. Thought it would go to 40. But management was so bad 3 years ago that I took my $1 gain or whatever it was and I bailed. Now, I got a call one day from a consulting client who has the newsletter. He said, hey, I never sold GameStop. What's going on? I said, what? I never sold GameStop. I got 1,000 shares sitting here. I was like, what? He goes, yeah, it's like 350. I'm like, sell it. He bought it for 15, 16. That kind of goes to show that if you just buy and hold good stuff when you get it cheap, sometimes you hit the hockey stick when you're fishing or golfing or just not paying attention. And that's why position trading is what I normally do, because when I analyze a company, I get what's going on. I understand what's going on. And I've learned when somebody really smart is excited about something and they're trying to make all kinds of money as an executive with whatever company or with whatever idea, you should stop and listen. At least take the time to work it through. And there's a lot of really good executives and managers who have jumped ship from bigger companies to go to some of these SPACs and small caps in the last few years. And it's because they needed to cash out, go spend some time somewhere else with something else that could become big. I've seen this cycle play out a few times in my career now. And I don't know when this turns over, or this one. I think the S&P 500 is a lot more at risk than QQQ. QQQ, you do want to buy the dips. How big the dip is, 15%, 20%, 30%, who knows? Maybe it's 5%. I will say, even though I think the stock market is at risk of a 20 to 30% dump, if the millennials just keep dollar cost averaging in and the boomers don't panic sell, you might only get about a 15% correction because that might give the Fed enough time to come to the rescue again. I'm not sure about that. I'm not sure at what level the powers that be need the stock market to be. And I do know that they let it fall once in a while, especially when the super rich have money in their pocket like they do now. It makes it really hard. Is there really pessimism brewing? Are we really over optimistic? Is everybody suddenly a trader? Is everything event driven? What I know is that we have a basket of stocks. And in that basket of stocks, I showed you my portfolio today. I bet there's no fewer than 5-10 baggers. Stock market has to come back because ultimately it's a discounting machine for stocks. And certain stocks, even the big ones, get ahead of themselves sometimes. Then you've got a bunch of stocks out there, like Roku, I think Roku is very vulnerable. But there's a lot of stocks that I think might be trading at double or triple what they should be trading at, just because of liquidity and the herd effect. When the herd starts to run the other direction, right, the cattle in the back get run over. IWM, which is the small cap index, Russell 2000, look at that. Does that not look like a period of consolidation? All the way from near the start of the year, like February. So it's chopped along for 7 months now. If there is a broader correction, everything gets sold because that's how correlation works. I think get down to here. If the Russell gets under 200-ish, 190s, 180s, you ought to be backing up the truck. Unless there's an Armageddon reason not to, I think that's where the truck is. We would have to have something really bad for it to go below this level. That high, that almost high. I don't like this formation though. This is a type of megaphone pattern. And a lot of times these patterns end up in lower lows. Same thing up here. I've been showing you this for years. This breakout probably precludes it. Just like this breakout probably precludes it. That's not for sure. This period, right? Because there's not 500 good companies. For the market, just look at that. If valuations matter, and they always do eventually, usually on an event, valuations matter, come back down here. And because of this low and the panic low, the coronavirus low was lower than the 2018 low, there's a possibility that we see under 200 on the S&P 500, absent of intervention, right? So now we have to have it in our head that fundamentals matter, but only sometimes, and only on events, and only as long as the Fed wants them to matter. It's not as easy to do this as it was 10, 15 years ago. So while everybody talks about Apple and Google and Facebook and Microsoft now, I'm trying to tell you, I saw this cartoon somewhere. Guy sits at a table and says to his broker, tell me in 5 years what I'm going to wish I had bought today. That's what you should be thinking about. What do I want to own now based on what it's going to be worth in 5 years, give or take? Can't really look out too much longer than that. It's hard to project a runway much longer than 5 years. 3, 4, 5 years, that's pretty projectable. At least in my experience, it has been. Value Line uses the 3 to 5 year outlook. That's what I use because I started with Value Line small cap survey back in the 90s. When you're using Value Line, what you saw, and everybody's got this data now, Value Line is no longer special, but you saw all the data that others didn't have back then. It came in this really thin paper book. You sit there and you page through the binder. Then finally they got their online version. Are we going to get all the way to the 500 round shiny number, or shooters? I think he said 474. I don't know, and I don't think it matters. That's what you need to be aware of. Whether it goes up a little bit more or has a mini correction doesn't matter so much. 5 or 10% in either direction, it just doesn't matter. Look at your list. You say, okay, what on my list? I'm not going to show the rest. So I'm going to put this on YouTube. What on my list do I really want to own? Well, everything that's on our plug and play list down here, our sustainable growth stocks and our dividend stocks. Every company in there has some sort of asymmetric potential. They wouldn't be on my list if they didn't. Every single dividend stock can offer a double or better total return in the next 5 years, and usually significantly more, and especially a lot more if you grind out another 5, 6, 7, 8, 9, 10% selling, conservative options 2 or 3 times against each position. You use that option selling cycle that I've talked about and I have illustrations on. We'll talk about a couple stocks. So I put out a trade alert today. I sold puts on Sirius, Discovery, and Viacom. And I think that Liberty, Sirius, and Comcast don't have to drop much for me to be able to expand my positions on them or get my positions back. I talked about why Discovery, why Viacom, and why Sirius. You should read this. Take a look at these puts that you can sell. 8.2% return for holding this for 2 months. And if the stock gets put to you, your net cost was $36.70, even though it's $39 today. I'm willing to buy Viacom today, and I have a position. So I can get more at $36.70 net, great. If not, I'm holding cash. I'm getting an 8.2% return for the next 2 months. Multiply that by 6. It's a 49% annualized return. Could you live with that on a money market account? If you're Chinese, you think that it's normal. Although now they're crashing. Discovery, 7.8% for about a month. And I'm just telling you, I think Discovery is a 3-digit stock in a few years. Sirius XM. I didn't have a position in Sirius or Liberty Sirius. Sold it out a while back. The Sirius didn't matter. It's been chopping around 6. Got an alert today. Took a look at the premiums. I was like, oh, I get 5% for 2 months. I can live with that. And if it gets put to me, if the shares get put to me, get a net price of $5.69, which is like 60 cents above its 2-year low. 2-year lows are important. Now, something you should know about Sirius and Liberty Sirius. So with Sirius, their revenues have been going up a lot last 18 months, while their expenses have stayed the same. What does that sound like to you? What kind of business model is that? Is that asset light or asset heavy? Asset light, right? Not a lot of input, but you're making more and more money. Why is that happening for Sirius? It's because they're not a US satellite company anymore. They have an app that's global. So now, instead of selling to 300 million people in the United States, really, I think it's 180 million potential consumers, now they can sell to somewhere around 4 or 5 billion people globally because they have an app. That's what the Pandora deal was about a couple of years ago. They have more content than any other radio network. It's not even close. They got to deal with Disney. Howard Stern, maybe not your cup of tea. I haven't watched them in years. But they have access to the whole planet now. And they're going to be in, I forgot the number, it was almost 90% of all new cars produced go straight into Sirius. It's all installed. Press a button and subscribe. And it'll be on your phone. And if you want to stream it from any Bluetooth device in your house, you can do that too. So it's not just for the car anymore. Warren Buffett has a position here, owns 1.1% of the company. What he really has is Liberty Sirius. Why does he have Liberty Sirius instead of Sirius? Because Liberty Sirius also owns all these other things. In particular, a third of Live Nation. Take a look at that stock. But the price of Liberty Sirius is basically based only on Sirius. So you get about a 30% discount to Sirius by owning Liberty Sirius. Might be a little bit less than that. Might be closer to 20% now. But Live Nation's gone up a lot. And this is when they had to redo the assets in that tracking vehicle because they had to bail out Formula One. So look what Live Nation's done since it went into that tracking stock. This basket of Discovery and Sirius, Liberty Sirius, Viacom, and I think Comcast soon. These are the companies that deliver streaming. I think Discovery is going to be the next Netflix after it merges with Warner. Will it go quite that gangbusters? I don't know. Law of small numbers, yeah, it could really move. I think AT&T ends up getting a valuation similar to Verizon, which means it'll go up $20 a share. I think Comcast as well, another one I want you to think about. Because I talked about since spring at least, but I think it was earlier in the winter. I've been talking about Viacom CBS and Comcast cutting some sort of a deal where NBC Universal and Viacom CBS merged. Well, did you notice that they just did a deal in Europe, which seems to be the testing ground for most American companies? Ford just did a deal in Europe. A lot of companies do deals in Europe to to get it right, and then they come to America. I don't think it's unlikely that Universal and Viacom, right, CBS and NBC merge. Then they save a whole bunch of money because of the overlapping assets, particularly in the news. Keep their A-list of stuff, have complete coverage, cut the fat, get rid of the low producers. You want to be in these companies. And with Viacom and AT&T, they have the ability to raise rates because you're not going to go without your internet. So if Viacom, CBS, and Universal NBC, or NBC Universal, whatever it's called, merge, think about that streaming service. I already have Viacom, CBS. I don't have Peacock, though. So I think all of these stocks are going to triple or better among the content companies, Sirius, Viacom, Discovery. And I think that Liberty Sirius probably does as well because they'll spin off Live Nation eventually, those shares, and take it as cash. Warren Buffett owns 19% of that company. Then AT&T and Comcast, after they lean down next year, are going to raise rates on your internet access. That's the way it's going to go. All right. Somebody asked a question. Thanks for sharing your holdings. And if you're a rare member at Fundamental Trends, right? If you're a rare member here, you get access to my holdings. Or if you're on margin of safety, you get access to my holdings. You use trailing stops or stop losses. So occasionally I use trailing stops, but usually only on trades. On my long-term positions, I don't use trailing stops. Because if something I own drops 20 or 30 or 40 or 50%, I know better than to try to buy it while the knife is falling. And I also know that any stock out there can drop 50% quickly. We've had one stock do that this year. What did I do here now that it's started to consolidate? I rolled out my puts, sold some more puts, bought a couple shares, averaged down. The mistake that people make when they average down on an investment, they do it way too fast. Well, look, it went down 3%. I'm going to buy more. Can you say martingale? It's like blackjack, double down, double down, double down, double down. Oh my gosh, I'm out of money and I never won it back. Only scale in at technical points that make sense and at deep discounts to what you think future value is. So when I scale into something, I'm doing it over months and months. So I just added Discovery and Viacom and Sirius. It's been months since I did anything with those. You have to let things play out. If I'm trading something, right, I'm taking 5 or 10%, I'm trading around the edges with options or something else. With options, stop losses, my opinion, they don't work very well. Because you get stopped out of stuff you don't want to get stopped out of. But on stocks, I usually have a 12% stop loss, trailing stop loss, right? Because if it goes up 30% and your stop is trailing you and just keeping a 12% gap, that's usually what I do. Because once something drops more than 10%, it usually drops quite a bit more. Well, 12% gets me out. Hopefully I bought it on the way up and I get out even or above even. And ETFs, I have a 7% trailing stop loss. One of the ETFs that we want to look at here before we close actually is EMQQ. Right, we've been keeping an eye on this one. Right, bounced off of my target line, came up here to the top of the buy zone. Now it's headed back down. The question becomes to get all the way down here. When you look at the underlying holdings, you go, yeah, I think EMQQ gets to around 40. And then I'm going to buy it. And I'm going to own some commie stocks. But eventually, the commies need the money too. So they have to lure the rest of the world back in. So this will be the price. This is going to be the price line right in here somewhere. I can't imagine it goes all the way back down here again, but it could. It could get down close to 30. Bad things happen with communists. All right. Any other questions? No. Have you read all the articles today? I think I put out 4 pieces today. Updated 1, put out 3. Got the Global Trends ETF report coming out tomorrow. Be a lot of the stuff that we just covered. And Next week, we start the webinars back on a Monday. They used to be on Monday. I'm bouncing around between Monday and Tuesday for last year. I'm settling on Monday. I like the idea of having all the articles on Monday, then being able to review them Monday night. If you have questions, you can ask the questions. We can add a Friday question and answer session to, a little bit off the air if we want to. But I've got people calling me during the week, so Tuesday night. Plus, there's Brewer games. Brewer playoffs are coming up. I didn't want to keep changing the schedule on you. 4 o'clock on Monday, that doesn't seem like it'll change. We'll take holidays off. So I'll get a built-in Labor Day, Memorial Day, and sometimes some other stuff falls on a Monday. All right. Keep an eye on the stock market. There's already things out there to buy. And keep some powder dry to throw into a couple of ETFs or, your Microsoft, Amazon, Apple, Alphabet, Berkshire bucket. But I'm pretty sure I'm just going to buy QQQ and Berkshire. To me, that's a great basket of stocks. Those are large caps. Make that the core of a portfolio, 23% of a portfolio. And then buy your asymmetric stuff around it. Yeah, I'll tell you what, if you've been selling puts all year with us, there's just no way that you're not up over 10% in premium. Honestly, and then you just roll out some of the ones that don't go well right away. You don't always have to take the stock. Rolling it out might take a year, but you'll get your money back on 2 or 3 rolls usually. Selling these cash secured puts, I just cannot tell you what a valuable tool that is. If you really care about making money, learn how to do the simplest option trades. You don't need any of the complicated stuff, straggles, iron condors, monkey teeth. I made that one up. Whatever. You don't need them. All you need to be able to do is sell puts when the market or your particular stock is oversold and undervalued, and sell covered calls when it gets ahead of itself, overbought. That's it. You might make 2 or 3 trades on a particular company per year with the options around the edges. Yeah, for those of you who say, well, I don't want small cap because they're more risky. One, statistically speaking, they're not more risky. Small caps are no more risky than large caps, as long as you stay away from the speculative hyper stuff. Like GameStop and AMC, they could both drop 50 to 90%. But when you're buying stocks like I am, they have so much cash on the balance sheet that you're getting them for book value, right around book value. There's not a lot of downside, right? Because you can just liquidate the company and get your money back. Learn how to sell the cash secured puts. I just can't say it enough, especially if you're retired. If you can learn how to sell options, I have the links, the 2 basic links are right in the resources, easy to get to. And I'll update the using retirement income options just to make it simpler. But yeah, option selling has made me a lot of money and helped me scale into positions, and it helps me avoid scaling in too fast. And again, try to think about your investments like you're an executive at the company who wants a bonus. Don't worry about what they said. Don't worry about the market's doing today, what the herd is doing. Think like those CFOs and CEOs who are switching from large companies to smaller companies, what they see. Because you know what? Eventually the herd will figure it out. If you can figure it out a year or 2 before the herd, you're going to hit that hockey stick on a lot of stuff where you make a little money selling puts for a couple of years, then bam, you've got this position and it goes straight up. Somebody asked about Soaring Eagle, which is going to become Ginkgo Bioworks in a few days. The symbol is going to trade from SRNG to DNA. Somebody asked why it did this. Does anybody know? Why did it do this? We've seen this pattern with a whole bunch of SPACs. What is this event? It's people redeeming. That's right. People redeem their shares and get their cash back but they hold on to the warrants. That's the rules. That's how it's set up. You can redeem your shares, but keep your warrants. That's what a lot of people do. I don't. I just keep them both. And then somebody says, hey, there's $10 in cash here, and I can buy it for $9.30. It's one of Kathy Wood's favorites. I bet if you go take a look at her trades the last couple of days, she bought some. So this will trade as DNA in a few days. I think a lot of platform companies we own, asset light. So the other companies that do what these guys do are saying, well, we have products to sell. And this guy says, have at it. Go try to sell your product when there's 100 other people out there trying to do the same thing. I'll help them do it. I will charge them to use our platform, our technology, our expertise, so they don't have to build out billion-dollar things like we did. They can come in here, pay a little fee, develop their product. We get a royalty for helping them develop it. And we're going to have 100 products that we don't have to sell that we still get income from. And by the way, the rent on the platform. I think there's a lot of amazing things coming in biotech. They have to do with DNA. I've been watching this space since they mapped it out the first time, in 2000, 2001, whatever year that was, the genome. 20 years later, we're finally starting to see the products. I think that if their technology is what I think it is and what the smart people are telling me it is, I think this could be a $100 stock. All right. I think if you have risk capital, this is one that you put 0.5% of your money into. And then write some cash secured puts, and maybe just maybe, all right, have a good day.